So today in this video, I don't want you to misquote me because I'm not saying that we are going or about to go through a market crash, but the way the stock market has been trading for the last couple of days does not stop someone from thinking, are we going through a crash anytime soon? You see, stock market crashes can be scary because they can happen at any moment without any warning. They can also result in big losses when it comes to your investment portfolio in a very short period of time. Because imagine you're about to retire and you have a $1 million portfolio. Now, if the stock market was to drop by 30%, that means you have lost over 300,000 just like that, just that quick, right? So that is the scary part when it comes to investing or when it comes to a stock market crashes. However, as an investor, you have to understand that stock market crashes are normal and they're bound to happen. They cannot be avoided. Now, instead of worrying yourself, you need to prepare yourself for one day when this happens. So in this video, I'm going to give you three simple tips to overcome a market crash. However, before we jump into the video, do not forget to smash the like button if you like the content, and also subscribe to join the journey of everyday investors who invest in the stock market for one day to retire on their own terms. So the first tip that I want you guys to grasp is you have to make sure you are not taking too much risk. Now, a stock market crash could result in your portfolio balance declining, but how you are invested could determine just how much it drops. Your asset allocation model is the percentage of stocks you have versus bonds. Now, stocks are considered riskier than bonds. If you have been investing in the stock market, you know that. So the more that stocks are in your portfolio, the more you could lose. And if you're feeling nervous about a crash, adding safer investments to your portfolio or your account could help reduce these losses. But the trade-off of lessening your risk is a hit on your return. And this type of move will also result in a lower percentage gain on average and during years when the stock market has a positive return. And as tempting as it may be to lower your risk during a bear market and increase it during a bull market, this is a market timing which is incredibly so hard to determine. Now, guessing it wrong could result in you lowering your stock exposure too early or exposing it too late, causing inferior returns. Now, that's why your best bet may be a model that you feel happy with during all market cycles. Now, I'm going to show you a table, right? If you look at this table, it's going to show you different asset allocation models which would have performed on average during the Great Recession of 2008, as well as the following year when the stock market recovered. Now, if you take a look at this table right here, you can see, if you take a look at the asset allocation, we have the average rate of return, then we have the 2008 losses, then the 2009 gains. Now, if you had invested 100% in stocks, the average return of will be 10.3%, right? And you can see how high it is. But then if you take a look at during 2008 recession, you could have lost 37%. And then the following year when the market bounced back, you could have gained back 26.5. Then if you take a look, if you had, let's say you had invested 60% stocks and 40% bonds, your average rate of return would be 9.1%. But then if you take a look in 2008 during the recession, your stock market would just have dropped just 20.1 compared to the 37%. But then if you take a look at the gains in 2009, you can see it was 18.3%. But then if you do 40% stocks and then 60% bonds, your average return will be around 8.2%. Then the losses, look at the losses, to only be 1.7%. And then the gain in 2009 will be 14.2%. And then if you did 100% bonds, you can see that your average return will be 6.1%. And the losses during 2008 will be 5.2%. Then the gains in 2009 would have been 5.9%. I mean, just like you saw in the previous table that I just showed you, you can see that if you can't take on the risk, bonds are the safer option for you. The problem with that is that the returns is not as strong as the one for the stocks. So the best thing is you can balance them up. You can be like 60% stocks and then 40% bonds, just depending on your age and how much time you have in the stock market or how much time you have before you retire. So that gives you a better option. So the next tip I want to give you is thinking long term when it comes to investing. Now, seeing your account balance decline significantly is never easy. I mean, you can ask any investor, but it could be more devastating depending on how soon you need the money. Now, if you are saving for something like your child's education in 5 years, a 40% loss could mean you can't pay tuition, right? But if it's something for retirement in 20 years, the threat is not as imminent and you will probably have time to recoup your losses. Now, it's for this reason that you should always consider your time horizon when it comes to investing. Now, the longer you have until you need the money, the more aggressive your holding can be, and the shorter the time period, the more conservative you should be, right? And the money that you need over the next year or two should never be put into the stock market. Actually, that's money you should be saving in your savings account. Now, for example, $100,000 investment into a large cap stocks could have lost around 43% of its value during the dot-com crash in the early 2000s, right? And then reduced to 57,000 by the end of 2002. Now, it could have gotten back to its original value for 5 years, but by the end of 2020, which I'll say 18 years later, it could have been worth 354% more, despite losing the 37% 2008. When you don't have enough time in your hands, it's so hard for somebody to wait for 20 years for their money to bounce back. So if you're thinking of retiring in 2 years, you don't want to put your money where, because when recessions happen, it can take 2, 3, 5 years before they can actually bounce back. And that's a risk you don't want to take, especially when you're about to retire, because you don't want to be in retirement and then your money is not enough to take you through your retirement. So that's why you have to also balance. I mean, if you're old enough and you're thinking of retiring in the next 2 years, bonds are more safe than stocks. But if you're young, you're in your 20s, 30s, even 40s, stocks are always the way to go. And as you get older, you have to kind of balance it out. You can do 30% bonds and 70% stocks. That helps you when the recession happens, because most times when recession happens, bonds tend to go up and then stocks drop. But nobody ever knows when they're about to crash, and that's why I told you timing is your worst enemy. But you have to look at your age. Like I said, if you're thinking you're about to retire soon, then you got to put that into consideration. Finally, my last tip is diversifying your holdings. Now, adding different asset classes like bonds to an all-stock portfolio is one way that you can diversify your holdings. But you can also reduce your risk by adding different types of stocks or sectors to your portfolio. Now, the stock market as a whole may suffer during a crash, but depending on the reason for the crash, certain industries may fare worse. Now, the tech stocks during the dot-com crash, real estate during the Great Recession of 2008, and the hospitality stocks during the coronavirus crisis of last year, it could be hard knowing which industry is going to be affected. And as a result, you could do really well if you have a lot of money in a sector that does well, but lose a lot of money if you invest most of your assets into one of that does poorly. And that's why holding a broad range of different types of companies can help reduce the concentration risk or having too many of your eggs in the same basket. Now, this table that I'm going to show you is going to show you the different sectors and how they performed in 2020 compared to how a blended portfolio of all 5 could have done. So, I mean, if you take a look at during 2020 pandemic, if you look at all these sectors, we have the information technology sector, we have the healthcare, financial, real estate, energy, and then we have the blended return. You can see that during that year, information technology was up by 43.6%. Then the healthcare was 13.3%. Financial was 1.7%. Then real estate was 2.1%. Then you have energy, which was 32.5%, giving a return of around 4.1%. This table, if you look at this table, it helps you basically when it comes to diversifying. Because like I said earlier, that when crashes happen, they affect different sectors in a different way. Sometimes it can be the oil sector, which is affected mostly, or it could be the technology sector, it could be the healthcare sector, right? Nobody knows. But if you have different sectors, like for myself, I'm invested in 12 sectors, right? And I know sometimes the oil sectors are affected. If the oil company is affected, those companies, of course, are going to be affected as well. But sometimes you're going to have it in a way that, okay, the crash happens, some sectors are affected more than the other sectors. So what's going to happen is one sector is going to compensate for the other one. So that's why diversifying also helps, especially when you want to preserve your wealth. I don't care how much you've been investing or how long you've been investing in the stock market. Looking at your portfolio going down 40%, and also depending on how much you have. Now, if you have $100 and it goes down by 40%, that means you have lost $40. I mean, that's a lot of money. But just imagine if you have a $1 million portfolio and it goes down by 40%, that's $400,000. That's a lot of money, right? So nobody can sit here and be like they're happy seeing the stock market going down. We all know stock market has always bounced back, but at the same time, you don't want to look at your stock or your portfolio going down 40%. And that's why you have to put measures in place to protect or give your portfolio a cushion when the recession happens. Like I said, the recession is always going to happen. There's nothing you can do about it. But nobody knows when it's going to happen. I mean, you can try to predict, but no one is ever right when it's going to happen, but it does happen. You see, you may dread a stock market crash, but these fears won't stop one from happening, like I said. Now, instead, you can better prepare yourself and your portfolio to withstand one. And while you can't stop all losses, you can find a level, right, that a level of losses that you feel comfortable with and that won't prevent you from reaching your goal. Now, thanks again for watching another video of investing in the stock market for financial freedom, and I hope you guys like the content. And if you did, please don't forget to smash the like button and also consider subscribing by hitting the red button below. That way you join the family or the community of everyday investors who invest in the stock market to return their own terms. Thank you. See you next video.